So how do you use whole life as an investment? Well, guess what? In this video, I'm gonna kind of throw a little curve at you because you're not actually. And here's why. Tune in. All right, so you're probably wondering, how do I use whole life as an investment? Well, more importantly, how do you use it for investing, even though whole life is not an investment? I repeat, it's not an investment, but you can use it for investing to actually amplify your wealth faster. I'm gonna give you some methods and strategies of how you can actually use it to do that right now. All right, as I said, as a disclaimer, whole life insurance is not an investment. I repeat, it's not an investment. It's illegal for me to even say that. So if you ever hear any other person talking about infinite banking and saying it's an investment, they are literally lying to you. It is not an investment. It is illegal for anybody with a life insurance license to tell you that, because the truth is, it's not gambling in the stock market. It's not going and being used in these different places. Whole life insurance is actually pretty dang boring. In fact, it pays you great, 5-6% plus dividend rates tax-free. It's all based on interest rates and things like that, going into like treasuries and bonds and whatnot. And so you're getting these guaranteed returns. It's not an investment. It's no more an investment than a savings account is an investment. And that's why often I'll refer to this as like a tax-free savings account, because whole life, although it does have a death benefit, it is life insurance, but it's also got this savings account component to it that does grow more than nothing percent that you get at your bank, and you don't even have to pay taxes on it. So just be aware, it's not an investment, but it can be an amazing tool to use with your investing, or even be used to fund your investments, just like a savings account would, but you get some additional advantages that a savings account will not give you. All right, so let's talk about how this really works, right? Now, infinite banking, when it comes to using this like with an investment or whole life as an investment, right? Again, this is not an investment, this is a savings account. Here's what happens, is that when you buy these whole life policies, and so you're aware, this is a warning, not all whole life policies are the same. They're designed very differently based on the insurance agent. Sometimes it's the insurance company. Yes, the insurance company does have an impact there, but it's the insurance agent that makes the biggest determination whether you buy a piece of crap or you're buying something that actually works well with investing. So you've got to be aware of that. I always recommend going with people that actually know how to invest. This is why I'm first and foremost a real estate investor. I'm a business owner. Secondly, yes, then I do life insurance. But I'm only doing that because I can't find other life insurance guys that consistently do it in a way that works well with investing. And I found this out firsthand. When I bought my policy, this is after I was a financial advisor, I quit, I became a real estate investor, I actually was able to retire when I was 28. And while I was starting to be in that process of building up enough passive income to retire, all these investors were talking about, you should be doing infinite banking, like it's amazing. And so I read the book by Nelson Nash, Becoming Your Own Banker. I said, all right, let me buy the policy. And I bought it from the guy they all recommended. It was expensive. I was like, this is really expensive. Is this supposed to be this way? And he said, yes, this is always the way it should be. If you try to put more money in to make it better, you're gonna get taxed. And of course I'm like, well, I don't wanna pay taxes, because who likes paying taxes? So I didn't do it. 2 years later, the recession hits. I'm in the hole so badly each month, I can't afford my payments, I lost the policy. I found out later it could have actually been designed better by lowering the cost, lowering the death benefit, allowing me to put in more money. They're called paid up additions. I could put in more money in that, and as a result, build the cash value faster. That tax-free savings account, not necessarily the death benefit, but the tax-free savings account can build up faster, allowing me to use that money for other things. That is the key with this. All right, so just understand that yes, you can grow that savings account. It's like a tax-free savings account, and you can still protect your family too. You can have your cake and eat it too. That's the truth. Now, there's this double dip thing you might hear me talk about from time to time. What do I mean by that? Well, here's the thing that I learned was false, but also I learned what the truth was too. You hear a lot of people in the infinite banking space talking about how you pay yourself back, right? They say you borrow from your policy, you go and invest it, or you go to buy a car or house with it, and then you pay yourself back. Guys, that is at best a half-truth, but kind of a lie. I mean, really a half-truth is in a sense a lie, right? Because you're not paying yourself back. What you're doing is this, right? And this is why it makes more sense. Because people would ask me, they're like, well, Chris, why would I borrow my own money? Why would I do that? Like, why wouldn't I just pull it out? And they're right, because it doesn't make sense to do that. Because you're not borrowing your own money. So here's what happens. You can withdraw money, but when you withdraw money, you lose the ability to earn interest inside that savings account, right? And especially when they're paying you better than the bank. So yes, you got that money over here, but when you withdraw money, it depletes it. So you don't earn interest over here anymore. But instead of doing that, you can leave the money in there and borrow the money from the life insurance company. So yes, you are borrowing money from them and you're paying them back the interest. You're not paying yourself interest, you're paying them the interest. But think of this like a line of credit, right? It's kind of like if you own a home and you decide to get a home equity line of credit. Yes, you get the access to the equity And yeah, you can pull the money out, but then you got to start paying it back, don't you? And you'll pay back interest only, you can pay back principal and interest, you can pay back whatever, as long as it's at least interest only. The problem is with the home equity line of credit, they have to charge you monthly payments. You have to pay back at least interest only. With the life insurance loan, it's not on your credit report. It's not even, you don't have to have a good credit to get it because you have the cash as collateral. Because it's guaranteed to always grow, they're willing to give you cash. By the way, bonus on this, guys, do you know that indexed universal life policies, banks do not want to loan on because it's not guaranteed, because you could lose money in those. That's why they won't give you money for it. But back to the whole life. So with the whole life, you borrow from the insurance company. Yes, they're charging you interest, but they're also paying you interest on all that money because your money's still sitting there. You're just getting charged interest on the money that they gave you. So what do? When you invest that money, you take that money and then take the cash flow, the returns from that investment, and use it to pay back the loan. So say, for example, you borrow $100,000 from the insurance company because you got at least $100,000 over here. You borrow the $100,000. Now that money comes to you. You go and invest it. And let's just say that you make $10,000 a year or 10%. You make $10,000 a year from that investment. You use that to pay back the interest and the principal on that loan. So you start paying the loan balance down. What does that do? That means less and less gets charged interest. It's not that the interest rate lowers, it's because the balance of the loan decreases, you get charged less interest. But on the other hand, over here where your tax-free savings account is, that 100,000 plus is still in there growing, compounding interest, tax-free. Nothing is slowing it down, right? Because you didn't pull it out. So you're making more money here, while at the same time, yes, you're paying down this loan, you're paying less and less interest here, you actually make a net gain on your money. So you make more in interest here, and you're also still making your $10,000 a year on that investment over there. You're making money in two places at once. That's the double dip. I even say to business owners, I'm like, hey, if you're using this for business purposes, now the interest you are paying them is also a tax write-off. So it's like a triple dip. It's even better if you use it for business purposes. But again, it's got to require you to at least pay interest only or pay down that loan so it doesn't compound against you. Because if you don't pay the loan, because there is no minimum monthly payment on a life insurance loan, you can pay it back however, whenever you want. The deadline is paying back at your death. But I recommend you do at least pay interest only so that it doesn't compound against you, so you're not having this race of two compounding interests working against you, right? That's how it works. So that's how I use infinite banking. That's how I use whole life insurance as an investment. I'm using this money to go and make me more money, grow my wealth. So and even like I mentioned, like cars and homes, I don't do that because I am paying the insurance company interest. I don't go and buy my cars and my houses with that. Now for investment properties, the down payment, because I can't get bank money from that. I love leveraging bank money, so I'll get a mortgage on a house. But for the down payment, I will borrow that from the insurance company with my money as collateral. And I will use that to put as the down payment and then take the returns from the cash flow of that real estate property to then pay down my loan. I'll also do this if I lend money to a real estate investor. If I'm making money from them, right? They're paying me 10, 12, 15% a year. I'll do the same thing. So just recently, I had a friend that said, I'll pay you 15% a year if you let me borrow $50,000. I pull that money from the insurance company, not from my own cash. My cash is still in there, earning compounding interest tax-free. But I was able to borrow that $50,000, loaned it to him for only 3 months, got the money back. I was still getting paid interest over here, while he paid me that money back plus interest. So guys, I was able to, again, double dip, make the money, paid it back, the loan, everything else. Everything was great. I charged a little bit of interest over here, but I also earned interest from them still paying me interest on the full amount. So I still made more interest over here, and he paid me interest on top of it to then, once again, go and do it again and keep reinvesting more. That's the secret, guys, is that I use it for cash flowing investments. I don't use it to go gamble in stocks and crypto and things like that. I don't even use it for like long-term investments where I won't get paid on for a long time because, once again, if I don't pay towards that loan, the balance increases against me. I like cash flowing investments to help me pay those loans back, even if the cash flow might take some time. I get real estate flippers all the time that say, I would love to be able to use that cash so I don't have to pay people interest on the money when I haven't made any money yet because I'm having to renovate the property and then got to turn around and sell the property. That could take me 6 to 12 months to do. Perfect. Yeah, they'll charge you interest, but you don't have to make any payments in the meantime. Make all your money, and then when you're done, use that to pay it back in. Heck, if you're even like, I even got a property lined up, I want to be able to do the next deal, I don't even have time to put it in, then don't. You can just take that money you just earned and flip it into the next property. Just pay whatever interest you want to pay on that if you want to keep it from compounding against you. There's so many flexible ways to use it. I'll tell you, there's the guy who works for me. You know, he actually has been using this since he was a teenager, right? His dad first set up a policy on him when he was in high school. He was going to use it as a way to fund his education, to fund his college. Well, eventually he went to college. He said, well, I can get interest-free loans from the government. So he's like, well, I'm not going to use the life insurance to be able to pay for my college because I'm going to get interest-free loans from the government. Well, he did that. And then when he got out of college, he had that choice again. Do I use it or not? He said, you know what? I'm not going to use it. His son was saying, I'm not going to use it for paying off my college student loan because the interest rate's cheap and I can pay it back later. Let's take that money instead, start a new business that will help me more than pay off my student loan. So that's the cool thing. You can use it for that. And the great thing is his dad, you got to understand, his dad wasn't just a guy just off the street. This guy was a stock investor. In fact, he owned a stock trading company, one of the largest education companies in the country, sold it to TD Ameritrade. He's done stock investing. He's done real estate investments. He's done business investments. He's owned all kinds of businesses. And of all his investments, if you were to ask him today, if you ask my employee's dad today what he likes, what he's loved over the years, he'll say the one thing that's always paid me, I can always count on, is my whole life insurance. Because that's the one savings account that's tax-free, protected from lawsuits of creditors. Even if they sue me, they can't get to it. And it's also the thing that's allowed me to grow my wealth. Guys, that's how you use whole life. Not as an investment, it's not the investment, but you use it with your investing to grow your wealth faster. Now, if you want to go deeper down this rabbit hole, go to moneyripples.com, click on the Infinite Banking tab, and just see how deep that well goes and just how much you can actually create in wealth right now.